Welcome back, my beautiful friends. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York. I'm your host, Zen Sams. Up next in our Business and Buzz segment, we have a returning contributor, Kyle Wohl, president of Revere Securities, and he's joined by Joe Collins. He's a U.S. Navy veteran, South LA native, and Republican frontrunner for California's 43rd Congressional District. Today, we're chatting about how the current very hostile American political climate is affecting the U.S. markets, now from stocks to real estate to all the in-betweens. This affects your bottom line and mine, as politics have the potential to impact the stock market somewhat. Why? Well, because political actions like regulation and laws have an effect on companies and on their fundamental performance. Presidents appoint economic advisors and fill positions like the chair of the Federal Reserve, and economic policies and the direction of the interest rates, which are all set by the Federal Reserve, also exert an effect on companies, a domino effect, so to speak. Now, these actions then have an impact on the stock market. Then we have media. All news that influences the economic and business environment matters to the stock market as well. The performance of oil company stocks, for instance, improved on the election of former President Trump because his campaign platform favored traditional energy companies over alternative energy, such as solar power. So it's all part of the bigger picture and actually one big ecosystem. Too bad none of them can get along. And here to chat some more are Joe Collins and Kyle Wohl. Welcome to the show, gentlemen.
Thank you for having
me. Yeah, thank you, Zen.
All right, Joe, I'll start with you. Let's talk about these rising prices and the economy. So rising prices and the economy and the war are all factors affected by political motivations that are actually affecting our bottom lines. And inflation is on everyone's mind these days. Everything from spiking gas prices to increased construction costs is putting a significant damper on consumer spending. And as we know, rising prices also impact home prices. If wages don't increase as fast as inflation, would-be homeowners may end up renting longer. Now, all these problems will continue to keep the U.S. in a housing shortage, an already painful national supply problem that has been continuing for years and shows no signs of improving fast enough. What do you say to this?
Well, I'll tell you that, in my opinion, I think that the rising cost in gas and inflation, that's due to bad economic policy on the Biden administration. I mean, cutting pipelines that we use to have energy independence, cutting leases on land when it comes to energy production projects, and all that contributes to the inflation. Now, when you talk about war, I think the only bad part about the war is that we're taking billions and billions of dollars and giving it to another country when we could be taking that American taxpayer dollars and putting it back into our own economy. But it's clear from what we see that this administration really doesn't care about improving the quality of life for Americans. This administration has proven that they will destroy America to help another country. And from what I've seen, just a year ago or 2 years ago, Ukraine was one of the most corrupt countries in the whole entire world. The way they launder money to other countries. When it comes to sex trafficking, I mean, Ukraine was the hub. Now we're giving billions of American tax dollars to this country when we should be taking care of Americans.
I couldn't agree more. And, Kyle, I'll kick this one back to you. But when you taking everything that Joe just said, we've always reminded people that it's important to note that the government and the Federal Reserve do not directly set mortgage rates, but they certainly influence them. For example, during the 2008 financial crisis, the Fed bought up mortgage-backed securities and government debt in the form of treasury bonds. This program was known as quantitative easing, and it consequently increased the country's money supply and encouraged banks to lend without as many parameters. And the result was lower mortgage rates across the board. But on the other hand, when the Fed is called on to maintain economic stability in times of inflation, it will set policies to pull money from the supply, which means borrowers will likely pay a higher interest rate on mortgages. What do you say to this?
Yeah, there's a there's a lot of factors that go in, and Joe is absolutely right in everything he just said. But when you start to bring in the Federal Reserve and mortgage rates and interest rates, they have a longer tail. And the tail has to do with what happened in March of 2020, right? So when COVID hit the economy, whether we reacted properly or overreacted, that's in hindsight right now, But the Federal Reserve aggressively tried to stimulate the economy, knowing that a large portion of our workforce was going to be out of work due to the shutdowns, not only in the United States, but the global supply chain. So once the new administration came in, they continued to pour money on top of this, not so much with Federal Reserve money by quantitative easing and things of that nature, but to continue to put money into policies for people to stay at home and not get back to work. And that truly exasperated the issue that we're talking about today. So that put us in a situation, we were already in a bad situation, but the economy was coming back to continue to throw more money. And thank God we didn't do the Build Back Better, because we'd be almost like the Weimar Republic in Germany right now, like the chairman of FedEx said the other day. We would be in a horrific situation. But the Fed is being forced right now due to a confluence of events, whether it be these bad policies of continuing to tax and spend, the unfortunate war that's going on in Russia and the Ukraine, and what Joe also mentioned with our economic energy policy, which is just nonsensical whatsoever. When a time when you have gas at $5 a gallon to not have the Keystone Pipeline open is just, to me, mind-boggling. So the Fed has no choice but to try to offset inflation. And we're in a bad situation right now. And it's going to be tough to get out of between now and the election. And hopefully people like Joe and some of the other people on his side of the aisle can wrestle back control of the Congress and the Senate and stop the policies that we're currently dealing with.
Yeah, and because I do believe that a lot of this is politically motivated, and I'll throw this one back to you, Joe. Governments, obviously, this segues beautifully into my next train of thought, but governments influence the economy by changing the level and types of taxes, the extent and composition of spending, and the degree and form of borrowing. So governments directly and indirectly influence the way resources are used in the economy. Do you feel many of the White House's choices are politically motivated? And more so, do you feel that governors are affecting their overall respective markets?
When it comes to the policies that the administration is pushing in regards to the stock market, I'm not even 100% certain if it's politically motivated, because what I see is that you got people who are right who want to be so far right, and you have people who are left who want to be far left, and nobody's coming to the middle. I think what you're seeing is a Joe Biden and a Democrat Party who hated President Trump so much that they're doing everything to destroy everything that he put in place to make our economy great. And so that's what I think I see right here. And I'm not necessarily convinced that it's politically, but I do know that it has to be personally. And the people who are feeling the repercussions of these terrible policies are the American people.
Yes, our bottom line and our pockets and our bank accounts are draining faster than you can say go, and nobody likes it. Kyle, at this point right now, and at times, we've heard this over and over again, but Treasury Secretary Janet Yellen and her team have disapproved of the way top White House aides have downplayed the risks from inflation and dismissed it as a short term, when in fact it has lasted for months and we are continuing to see this trend. Now, the administration is saying, well, while we face additional price pressures like Russia's war in Ukraine, the U.S. economy is on strong footing and we expect inflation to abate over the next year. What's your professional opinion?
It's really hard to know when inflation will abate. Inflation can be the worst thing that can possibly happen to the economy and the financial markets. But also, I like to study history, and we're all students of history, right? Historically, we're still at a pretty low point on the interest rate curve. So I don't want people to panic and think the stock market's going to crash. We're already down 20% from the highs in the S&P, which puts us on the verge of a bear market, right? But historically, interest rates, the average around 3 to 3.5%, so pretty good for the overall economy. I think the markets will calm themselves. I don't see any impetus for the markets to rally between now and the elections. But I do think once people realize that the Fed, and I think the Fed has to lead this, not the politicians, if the Fed gets to the rates somewhere comfortable and they say, okay, we think inflation is starting to tame, it's starting to temper, I do think you'll start to see some volatility pulled out of this market where you don't see up 600 points one day, down 400 points the next, or down 1,000 points and up 600 points. So hopefully that will happen, and then hopefully we can get some luck with the war in Ukraine, because I do think if that war can slow down, that could give a pretty good boost to the overall economy, especially when it comes to commodities and soft commodities such as wheat.
Yeah, absolutely. And this is affecting every single household, every single business, every single market across America. It's a terrible ripple effect. All right, Joe, this is a very fitting question for you. And as Ronald Reagan might have put it, here we go again. History may repeat itself. 42 years after inflation helped Reagan sweep into the White House and return the Senate to GOP control, today's surging prices are now threatening once again to upend a Democratic administration. And President Joe Biden and his fellow Democrats in Congress are desperate to avoid the fate of President Jimmy Carter, who was ousted after just one term. Now, Biden so far has had little success in either figuring out how to douse inflation that's running at a 4-decade high, or even convincing voters that it wasn't his $1,400 stimulus check that acted as the catalyst to this disaster of an economy. What are your thoughts here, Joe?
I really feel like this right here. It's not even just the Biden administration. I mean, you got to look at the politicians that we have in office. I think the average age is like 69 years old. These people are literally taking us back in the days with the type of policies that they've been pushing. So I hope to see a whole brand new slew of young people getting involved in politics and taking our country in the way that it needs to go. Because I mean, you look at all the policies from the Democrats in California, with our open borders, with the surplus that we automatically have after giving hundreds of billions of dollars to other countries and illegals, and then you look at the Biden administration that is literally killing the United States energy platform. We definitely need better. We need better politicians. We need younger politicians who can actually see into the future and stop living in the past. Because I mean, the definition of insanity is doing the same thing over and over and over again, expecting different results. And that's what these politicians are doing. They're so old. They don't have the foresight to see into the future, to see what the younger Americans need in order to be successful adults. And they're really crippling our future.
Yeah, they really are. And to your point, it's not necessarily inflation is inflation is inflation. And maybe Kyle, you could pipe in here, because perhaps the biggest problem for Democrats is that there's little Biden or any president can really do about inflation, right? It's really the Fed that has responsibility for price stability. And the central bank is currently mapping out the steepest interest rate hikes since 1994. But that motion is ushering in its own dangers, and a growing number of economists, Kyle, are now warning of a recession in the next 2 years. What do you say to this? You have about a minute.
Yeah, I mean, there's a high probability, right? We've put ourselves in a horrible situation, like I mentioned before, where we just continue to print more money and spend more money. And now the Fed has no choice whatsoever, but to try to fight inflation. And the only way to fight inflation is to raise interest rates. You could go back to Volcker in 1980. I mean, they broke it. I don't think we're going to have to go to 18%, where your CDs are paying you 21%, your mortgage rates are 25%, but they have to fight it. Now, hopefully, again, we could get a little bit of help from Ukraine and Russia, but it's going to be hard for the next probably 6 months. But I am very optimistic that we can get it under control, especially if people like Joe and his colleagues can take back the Congress.
Love it. Love it. And with that, we are officially out of time. Gentlemen, thank you so much for such a great segment. It's so enlightening speaking to you. Kyle, always a pleasure. Joe, thank you so much.
Thank you.
Thanks.
Guys, you definitely have to check out Joe Collins. Head to his website, joecollins3.com, and then head to Revere Securities, reveresecurities.com. That was our business and buzz segment, and that was our returning contributor, president of Revere Securities, Kyle Wool. You're listening to A Moment of Zen right here on 710 WOR, the voice of New York. We'll be right back after this.